Hello guys, welcome back. In this video we are taking a little bit of a look at Shopify. It is a company that has been completely annihilated in terms of its stock price, about 80% down since last year, absolutely devastated. It's a fairly recent IPO back in 2015 and it's actually reporting earnings in July 27th. This is 2 days from now. It's going to be next Wednesday pretty much. So this is a company that is a very massive hit, pretty much, a very trendy company that has been doing well in the e-commerce space, yet it was massively overvalued. And if we take a little bit of a look, we'll just start with stock news here. You will see that there have been discussions about the shares finding new life. For example, here some Shopify partnership with Airwallex, for example. Pretty much some discussions about a reversal in what Shopify has been doing with a recent crash. Now, if we take a look at the metrics of the company, you will see that this is a very dire picture. You will see that in the past month, the company stock price has been climbing a little bit, but recently just fell as well. Now, the 1 year high is 176, so again, it's like 80% down. And last Friday, it was actually down 8% almost, with the rest of the tech market slumping again. Now, if you take a look at the 5-year chart, you will notice that the company has been doing fairly well over the years. And then all of a sudden, back in November, there was a massive deterioration of its stock price happening. And so we saw it crashing to the ground, about 80% down. The company has also already had a split. At some point, it was very high, so every one share was converted to 10 shares here. 10 to 1 split was what happened with Shopify, which means that at some point, if we do the multiplication, the stock price was at about $1,800. And after the split and following the crash of the company's stock price, it's actually been going down even more to 176 at some point, and 37 pretty much today. So absolutely insane. That would be 370 before the stock split. So imagine the company stock price going from $1,800 to $370 is the kind of fall that you are looking at here. Absolutely insane. Now, regardless of how far down it has gone, it doesn't mean that it's an automatic buy. The amount the stock has dropped is really not an actual reason for why we should be buying this company. The reason to be buying this company is actually when it has fallen quite some and it's cheap enough to buy it, and it's actually doing well enough to actually warranty one of our purchases here in addition to our portfolio. Now, we will examine the financials and try to discover this. The PE ratio of the company is sitting at 311, and it's actually growing a little bit from 2021. Same thing with the price to free cash flow ratio, which is still very high, although it is going down, still at 107. So these values are already a little bit weird here. They are already pointing to some danger from purchasing the stock, even at its current price at about $37. We will see that in more detail a little bit later, because we really need to take it through our stock evaluation tool to be certain of it. But the first things first, we do examine the financials of the company in more detail before we move on to an actual evaluation of the stock price. Now, the outstanding shares have been climbing as well, so the company has been issuing shares. This is another very bad sign for an investor, because when we're buying a stock, let's say that we bought back in 2017, the company's float, the outstanding shares was less than $1 billion, which means that right now we're sitting at 1.3 almost billion, 31% higher from its lows in terms of its outstanding shares back in 2017. And this means that we are getting diluted, meaning that if we bought shares back in 2017, now our shares are intrinsically worth less, about 30% less, because there is more of those in the open market. And so this is a very big problem for an investor, and this alone could be a very big reason why I wouldn't buy this stock right now. Now, the total liabilities to free cash flow is 5, or less than 5 really, which is what I'd like to see overall. Now, remember that somebody could say that outstanding shares have already climbed to 30% higher, and if I'm buying today, I'm buying at this level, which is true. Yes, if you're buying today, you're buying at this level, but if you're looking at a company that keeps issuing shares, that is a little bit of a danger here, because it kind of tells you about the board, the directors really, what they are planning to do and how they are treating their investors. And so if they are actually issuing more shares all the time, then why would they not treat you the same? Now, there is a little bit of a less risk nowadays because the stock price is down, and they probably wouldn't want to keep selling, even though they still did, like in 2021, since March 2022, they were still selling. And if we take a look at the 1-year chart, this was when the company's stock price actually was going down. And so, yeah, they were still into the weakness, they were selling. So that's not a great sign to see for a board. And this is why this kind of metric here is really, really important, and you need to be taking a very, very close look at this one. Now, the nice thing about this company is that it has been growing a ton. You'll see that the revenue growth has been growing tremendously, especially the last 3 years. Same with the net income growth, same with the free cash flow, same with the total equity growth, although they have been printing shares like crazy. It's still a very nice picture to look at when you are looking to invest in a company. You do want a company that keeps growing, and this is a very, very beneficial thing for an investor, of course. So there are some green signs here and some red signs on this side. So for the net income margin, the company has been dropping its margins. It has been doing worse. Probably competition, probably the issues with the supply chains and all that have dropped margins, and the company's margins right now are fairly low, 3.7%. Even though they are basically an e-commerce store, pretty much. So the return on equity, on capital employed and all that is fairly low as well. And again, that's pointing to a company that's not really handling their return. It's not really providing very great returns. It's not handling their equity and their capital employed in the best manner possible to provide returns. Although this, this could be temporary as well, and it could change in the very future. But it's worth noting. And the next thing that I'm going to be checking is the financial statements, and we're going to start off with the income statement, starting from 670 million to 4.6 billion here in 2021, growing precipitously in terms of their revenue. Very nice growth here. And same thing goes with the net income, which is a thing that I love to see, from minus here to very, very positive here, 2.9 billion, almost 3 billion here in terms of net income. That's a company that is very, very nice because it has been growing its net income. So you'll see with many companies that they are negative in terms of net income, and they keep going into negative territory for years to come. So this one has reversed course, and it's looking like it's getting to great profitability here, which is a very, very nice picture to see. Now, in terms of the balance sheet, what you like to see here is the total liabilities, which are sitting at 2.2 billion, which is not that much. I would actually expect to see much more. I like the way that they don't have too many total liabilities here, and this is why when you compare those to the free cash flow, you're getting a very low number. We got less than 5. This already tells us that the free cash flow that the company generated last year is 2.2 divided by 5, so it would be like about 400 million or so, 450 or so. So the total equity is sitting at 11 billion here, but remember the company has been issuing shares as well, additional paid-in capital. That is not that much over here, as I'm saying, but still they have been issuing some shares, and that has definitely helped the total equity here. Now the cash flow statement, you will see that we are sitting at 500 million in terms of the operating cash flow, and this has a lot to do with the fact that the company has had other non-cash items and change in working capital. So they basically bought something and they spent some money on that, some cash here, and this is what is getting deducted pretty much over here. This other non-cash item is probably going to be a one-off potentially, I would think. But we're going to be seeing what they're going to be doing in the next fiscal year. So we could even see take a look at their period, their quarterly ones, and see that, yeah, this is actually going down quite significantly here. And this is why we are getting a difference in the other non-cash items here. Okay, even though their net income is going into negative territory, which is not a great thing to see for Q1 2022 at least. So the next thing is the cash from investing activities here. It is in the negative, which is generally speaking normally a good sign for a company because they are purchasing investments and they are pretty much not selling too much. So they are, in terms of purchasing and buying or selling, this is a company that is basically a net buyer of investments here. Okay, so in terms of the financing activities, they are in the positive, which means that they are getting debt. They're actually increasing their debt here. So they are increasing their debt, although they didn't have a lot to begin with. Remember that they are making, about 450 million in terms of free cash flow, and they had 2.2, I believe, in terms of total liabilities. It may have been a little bit more. But they don't have that much debt, and that's a good thing to see. They're sitting at about 2.5 billion in terms of cash over here. But if we go back, we can take a little bit of a look at the debt, which you will see, for example, here that the long-term debt is sitting at 1.15 billion back in 2021, that is. And again, we can always be taking a look at the quarterly ones if we want to get the very, very recent one, 1.176 billion in terms of long-term debt, which is not worrying at all. It's not a problem for the company, at least for the time being. Now, the last thing, we can take a look at the stock evaluation tool. And remember, we saw a company that in the last quarter, it hasn't been doing tremendously well. It looks like they're actually losing money again in terms of their net income. And so this can be a pretty big problem. And this is why we're going to go very low in terms of revenue growth here, because the company has been slumping and it has been not performing well lately. So we have to account for that. It seems like their net income has been going down and again into negative territory. They're getting affected by what has been happening in the markets lately. So I'm going to be conservative here. Just see what I'm getting out of being conservative. I'm gonna go with something like 3. Let's go a little bit more, 6 and 9 here, and see what we're getting out of this. Conservative estimates again in terms of revenue growth, especially. This could grow much more in terms of revenue, but I want to be super conservative, at least to begin with, and see what I'm getting. Now, the net income margins of the company all over the place, and they were actually 60% over here. This probably means that there was some sort of a sale or something of that sort that affected the revenue, and this went much higher here. But I'm expecting to see a net income margin that is about maybe close to this one, and a little bit less, actually, frankly speaking. So again, this is a little bit all over the place. You can try to see what the company has been, what the analysts actually have been expecting for the company's margins, and play along this one. But I like to go conservative and see what I'm getting out of this. Now, if I go 3, 7, and 9, again, what are 3, 6, and 9, and let's see what we're getting out of this one. And the free cash flow margin that I'm going to be using, I'm going to go with something rather typical, because again, this is all over the place because of the free cash flow being some positive, some negative years. So I'm going to go 80, 90, and 100 here. An annual return of 13% is what I want to be getting. Now, I hit calculate with these values, and I'm getting much low prices here, much lower projection results, because I went very conservative. Now, if we want to change that a little bit and say that the company will be growing at a much steadier pace and actually keep up with their previous years, let's just go with something more like 20, 30, and 40, which, yeah, the company could achieve. And if we do that and hit calculate, then we're getting something that makes a little bit more sense potentially for this company, and a medium of near 10 and a high of near 20 here. And if our net income margin somehow become higher, then we can go 8, 9, and 10 maybe here, and we will have a little bit of a different scenario in which we're sitting at 13, 22, something of that sort. Still much lower than the current price. And so for these reasons, I'm out, as the Shark Tanks would say. But for these reasons, yeah, I would probably not be looking to buy this company at this current valuation, because it's very expensive for what it is right now. And it also looks like they're not doing as well as they were in the previous years. It looks like they're having a little bit of a downturn right now in terms of their financials. And so it may be not the greatest time to enter Shopify right now. Maybe it will have even a chance for even better prices here. And yeah, I think it's still a company that I will have to wait for it to go down significantly before entering. And remember that taking a look at their metrics here, you will see that their net income margin, for example, has been a little bit all over the place. You will see here from negative to positive. It's tough to deduce what they're going to be doing in the next few quarters, and you can obviously take a look at analysts, but even that can be misleading potentially. And it is really one of the things that I really don't like to see from my companies, the companies that I hold. I want them to be much steadier than this. I do understand that they are growing, but at this current valuation, I can't be entering the fray. It needs to be much lower, in which case I would actually reconsider and refactor this kind of risk. So thank you for watching the video. Please remember to leave a like and subscribe, and I'll see you in the very next one. In the meantime, take a look at the video that I created earlier, and in this one I am talking about Meta and what they are doing right now, what we're expecting from them in the next few months or so. Thanks for watching, and I'll see you soon. Bye-bye.